Hi there, I'm Dermot McDermott, bringing you this special look on Asia today with Stephen Schwartz, Chief Asia Economist from BBVA in Hong Kong. First of all, Stephen, can you tell us more about the slump we are witnessing in Asia?
Well, we think the sell-off in Asia has been triggered by the talk of QE tapering by the U.S. Fed. We knew all along that once the unwinding of the quantitative easing occurred, some of the emerging markets that had been recipients of big inflows the last 1 to 2 years would be vulnerable to a reversal of capital, and we think that's exactly what we're seeing. And the economies that are most vulnerable with current account deficits and domestic problems on the inflation front are really bearing the brunt of that adjustment, such as India, Indonesia, and to a lesser extent Thailand right now.
And now focusing on some South Asian countries which are being affected by this, let's begin with Indonesia. We saw Indonesian stocks heading for the largest 4-day fall since 2008. There is growing concern that capital outflows will accelerate. Well, Stephen, tell us what you think.
Yeah, I think the two factors on the domestic front have exacerbated the decline in Indonesian markets. One is the release of the second quarter current account data that came out last Friday, which showed a widening of the current account deficit. We think the current account deficit will narrow and is sustainable, but it exceeded expectations at over 4% of GDP in the second quarter, and that probably spooked investors and led to steeper pressure on the currency. In addition, back in June, Indonesia raised domestic fuel prices to reduce the subsidy that it implied, and that gave rise, as expected, to a big burst of inflation. And so investors are watching the central bank and the possibility of more interest rate hikes, and that's hitting the domestic bond market. So all of these domestic factors are exacerbating the sell-off, but we still have a lot of confidence in Indonesia's growth story, and we would expect that once valuations become attractive, capital will eventually return.
And Thailand has fallen into a recession after the economy contracted slightly during the April to June quarter. We saw the currency drop to a one-year low and stocks fall on the back of this news. Can you tell us more?
Yeah, the second quarter GDP outturn in Thailand disappointed expectations. We ourselves expect full-year growth in Thailand of a little over 4%, so it's still a reasonable growth story, we think, but domestic demand has weakened and the sluggish external demand has also contributed. Thailand's symptomatic of the impact that these capital outflows is having through the region. The capital inflows from the very aggressive monetary easing in the U.S., Europe, and Japan has been a helpful tailwind to domestic demand. And now that we're seeing yields in the U.S. come up and the capital reversing, it's hitting domestic demand. In some ways, it's a healthy thing because credit had been growing too rapidly in some of these economies, so it's helping to reduce overheating pressures. We do expect these pressures to subside soon.
And yesterday, hitting headlines was the news that the Indian rupee fell to a record low against the greenback. Do you think we should be concerned that the rupee sell-off threatens to drive the country towards a full-blown crisis?
Well, in India, as elsewhere in the region, we don't think the current sell-off is causing systemic risks to any of the individual economies or across the region, because the underlying fundamentals in these economies are pretty strong, especially high foreign exchange reserves. So the central bank has taken a conscious decision to allow the currency to adjust in response to these external pressures rather than intervene heavily to support the currency. So they want to protect their reserves, no doubt. But reserves are over 270 billion in India, and that should be enough to weather this storm. But India faces very severe structural challenges in reinvigorating its reform momentum. Foreign investors have lost confidence in the government's ability to push through market-friendly reforms in terms of market liberalization, opening the economy to greater investment, and so much more work needs to be done. It's really more of a government problem than a central bank problem at this stage.
And before we finish, Stephen, do you think this is just a short slump, and would you be more positive in the longer term?
Well, in general, we remain confident in emerging markets in general and in Asia specifically. We think that we're seeing some short-term volatility because of the expectations of QE unwinding in the U.S., and it's better that this volatility is occurring early. It really started back in May, and it's in some ways a good sign that this happens early rather than later when the actual tapering begins. But certainly the volatility of recent days must be unnerving investors and policymakers alike, and it's going to take kind of cool heads to calm this, but we don't see any of this as an immediate threat to the long-term growth story across the region.
Thanks, Stephen, for that. Well, viewers, make sure you also look at Thomas Haplin's press review today as he looked at how markets have been shut down after major floodings in the Philippines. Have a nice day.